So first and utmost, like nothing that we say here is financial tax advice. There may be some exception, I don't know today, but I would say no exceptions unless our experts say he can be taken certain portions of today as tax advice. But what you're sharing here is just our knowledge and our experience, and all the content provided by Crypto Vagabonds in any platform is only for educational, informational, and entertainment purpose only. So that being said, I'm going to stop sharing my screen. The disclaimer is there. We have someone today who has come here before. Last year when we are doing one of the crypto talks, he kind of joined us, and then we kept in touch sporadically, and now here we are. He was first, I guess, just like one of you guys here, and today he's a guest speaker. So Neeraj, I'll hand it over to you, please.
Sure. Well, thank you, Booth, for that warm welcome. And just a bit of background. My name is Neeraj Nargakatti. I'm from the UK, and I'm what you call, I suppose I've Googled it, and I haven't found anyone who calls themselves a global crypto tax accountant. And right on, Maria. And the reason they call me that is because as a tax accountant, I can save you money. Like crypto, I bounce up and down, like in this chair. But some people say that I'm like volatile, but don't trust those rumors. And global because I think the world of my clients and anyone who I speak to on the subject of crypto. So this is a fascinating space. And today, just wanted to speak over a few topics. It's more like an introduction to, what exactly are crypto taxes. So, Booth, do you have the slides at all? If you don't, I've got them on my screen, and I can do a screen share. It's totally up to you.
We can't hear you, Booth.
Oh yes, we do have them, but I think it's best if you share them with the
okay, sure,
with our group. So
okay, give me a thumbs up if everyone's able to see what's on the screen.
Perfect.
Cool. So I'm probably one of the few guests, first of all, who actually dresses like they do in their profile. So I'm not any slimmer or fuller faced. I'm exactly what you get on the tin. And speaking of tins, I'm probably the only one as well who's doesn't have baked beans as buttons on their calculator. Maybe just that one little thing there. But yes, this is totally all about let's talk about tax, and it's just to define what exactly are crypto taxes, because of course, for me, it's more the other way round. Unless there is a specific tax which is on cryptocurrency, then it's actually more an existing tax which is applied to crypto. So the three themes that I'm going to be touching on this evening are, the definition of what exactly is it, when do you pay it, and we'll touch upon a few points there, and what is a realized gain and an unrealized gain. And then we'll head on to some Q&A. So let's get right into it. So I actually thought well, not really all weekend, but a definition that they usually say a definition is best when you don't use the words to define it, but I almost got away with it and then put crypto assets at the end. So it's basically any amount that you pay to a revenue or tax authority that relates or is about crypto assets, either transacting, using these assets. So the first one is usually, I think the easiest way to explain it is income tax. So say if your employer pays you in crypto, then you would typically pay income tax on the amount that you received. It could be on the day of the exchange, or it could be you know, in the middle of the month. It might be an average of whatever the monthly exchange rate, depends on the country really. And you might also pay some social security there as well. But mainly, if you receive money in crypto, someone who's like maybe a self-employed gardener who wants to find a new market and, you know, says, I accept crypto, then the value of their services is taken as the point of reference, or, you know, the invoice value for what the exchange of crypto is taken as the amount that you pay in tax. However, we will mainly focus on the second one because this is what the majority of crypto and people in the crypto community tend to face, is it's investing in crypto. So it's, at its heart, it's when you sell, capital gains tax you pay on when you sell your asset, in this case crypto, for more than what you paid for it. And that's going to be the main theme of this talk. So I thought that almost said, why do we pay crypto tax? Why do we have to do that? No, but it's more when. And here it is, it completely depends on where you live. And for example, in here in the UK and USA and most of the English-speaking countries, Australia, New Zealand, Canada, it's when you dispose of crypto. And by that I don't mean when you just, you know, throw your hard wallet in the bin. No, it's not that. Though you might be able to even get a tax loss, who knows. But it's basically when, you know, I think change hands is a nice way of putting it, because it can mean anything from selling your crypto, spending crypto in exchange for, you know, good or service as well. Exchange, so this can mean, you know, trading one crypto for another. And even if you don't, for want of a better expression, cash out or turn crypto, even if you go from Bitcoin to say Ethereum back into a USD crypto coin, stable coin, and you do a triangle like that, and you think, oh, I haven't converted back into cash or into your bank account, then actually some tax authorities, like in the UK and USA, believe that that is taxable. So that is, it's quite an important thing, which, you know, people may not think, oh, I haven't converted it back into, you know, cash, but you might find some clients have found that that's been maybe an Achilles heel or something that people haven't been aware of. And then you have giving it away, and this is in the most general term. So it could mean when you give it away to a friend. I think that's the best way to describe it. But there are times when you don't pay. For example, say if you donate it to a registered charity, that doesn't usually produce tax. And even some instances, maybe giving it to your spouse as well. So in the UK, you've got some beneficial regime where you can donate it to your wife or your husband, or even civil partner as well, and you won't face any tax. It's just what we call no gain, no loss. So next up, you have in Netherlands, and some of you are quite familiar with this country as well. And here, instead of looking at when you sold it, when you bought it, the tax authority there, how do you say, Belastingdienst? Belastingdienst.
Wow, very good, Neeraj.
Thank you. Heel goed. So the Netherlands tax authority, instead of taking it on every single trade, what they would do is calculate your net assets. So it might be all your assets minus all your debts, and you have a value at the 1st of January. The taxman applies what you call a fictitious or presumed return, and then you pay a tax on that. But we'll go through a simpler example later, because I was about to include the actual numbers, but it looked more like, yeah, I'm going to get into rounding numbers and where did that number come from and where did this number come from. So that's another approach that you see. And finally, you get the countries who are the lucky devils, where whether it's gain or loss, however you trade it, however you cut it, whichever, donate it, give it away, whatever. If you're what you call tax resident in either, like say, Dubai, or of course within the UAE, or Portugal, then there is no tax actually payable on either income or capital gains. So that's a nice place to be. And we're often finding that this is a very popular destination for, yay, I know. Oh, are people actually based in UAE or Portugal?
I am based in Portugal. I'm registered base. I'm a tax resident of Portugal, so to me it's
Oh.
perfect.
Oh, so are you in the same time zone as me?
No, I'm physically in Netherlands, but
Okay.
I'm registered. I'm a legal resident of Portugal.
Okay, fair enough. Brilliant. Cool. So next up, we'll discuss. Really, are we on this slide already? Yes, we are. Blimey, gosh. I'd say we're just rattling through this presentation, but I intentionally didn't put many slides on. So yeah,
That's great. I think there are going to be loads of questions, Neeraj. Don't worry.
Okay, sure. All right, cool. So now, first of all, what is a realized gain? Or first of all, a gain is simply an increase in the asset value. That's the best place to start. And the realized gain, so this is the example that I give here. So say if you buy a house in, it could be, let's use 1st of January 2021, which is as good as any time, for $50,000, and red means buy, and then you sell it for 100,000. We're going to skip straight to C because, you know, B is just getting in the way, right? So, and it's not as exciting, eh? So we just go straight from 50,000 to 100,000 by in 2 years' time. You're actually parting cash there, and you're receiving cash there, and it's turning it into cash is the equivalent of saying it's a realized gain. Okay, so the difference that you'd pay is the amount that you'd be taxed on this realized gain, and this is, you could call it the UK and USA approach, or a lot of the English-speaking countries and many countries in the world. However, if you, for example, you bought it, of course, on day one or year one or year zero at $50,000 at point A, and you just live in there or use it as investment property, for example. And at year one, this is where maybe a country like Netherlands would tax the hidden value. So it's the locked up value. Even though you haven't sold your property, you own it, the hidden value there, or the increase at that point, will be taxed at year one, and for as long as you live there, or for as long as the asset either even stays the same or it decreases, increases, that gain, that unrealized gain, will be taxed. And so the example of a realized gain, that's right. It's a similar thing for crypto as well. So, for example, 1st of Jan, you purchase, $50,000 of crypto, and you sell exactly the same for 100,000. And you can take a similar example. I wish I had a flash way to turn this into a coin or something like that, but oh well, maybe next time I'll be funky with the animations. What will happen is that, and the tax rate is 20%. So let's break this down one step at a time. What is the realized gain, and what tax do I pay? So looking at this example, we just say the realized gain is the sale price, selling price, less purchase price, and which essentially follows the example above here, which is that, that realized gain of $50,000. It's the amount that you pay tax on, is the best way to put it. And what tax do I pay? This would be the tax rate that you have times your realized gain, the tax on which you pay capital gains, gives you 50,000 times, it's almost like dividing by 5 really, which gives you $10,000 to the taxman. So depends how you look at it. 20%, it can be viewed as high, and people in the UK have 20% of a very high number, of course, is going to be a very high amount at the end, and people are known to escape the UK tax net and move to places like Dubai and UAE. Other people think, well, my income tax rates are more in the range of like 40% or even 45%, and paying 20% is actually quite a good deal. So it really depends on your outlook, and some people think even 10% is too high. So it's really up to everyone, each one really. So the next example is, fitting this on one page. So that's why I said here's a very, very simplified. So I wouldn't use this example to calculate the taxes, because the Dutch taxman, to be fair, actually, in Holland, they are some of the nicest tax inspectors I've come across. I've dealt with a couple of them, and they are very friendly. And in fact, post Brexit, actually, Ireland and Holland, the Netherlands, sorry, have been seen as the two places where VAT registrations have seen VAT registrations have increased because of the the friendliness and the location as well, that and the ports in Netherlands. So it's just a little sidetrack there, but it's sometimes useful to throw out a factoid or two. But coming back to this, the example I give here is similar. We've just converted dollars into euros, of course. So on 1st of January 2021, I purchase the 50,000. I sell it. I haven't even sold it. Gosh. I just made an increase. So I just feel better. I feel twice as good for having sold it for 100, for having kept it at 100,000. Gosh, I'm so excited by selling it, but I don't want to because I know it could go higher, even higher. But yeah, the tax rate is 20%, and this is an interesting. It's something which it might not even correspond with what the investment picture is, but it's like a presumed or like an effective or a deemed rate of return, because it's a percentage that is there in order to calculate like a tax base, and I'll explain that later. So first question is, what is the realized gain? And similar thing to what we saw earlier, because I haven't sold it, technically I should have used the 75, but hey ho, we'll just use this. It's the unrealized gain is 50,000 euros, because we're taking the difference between the worth or the value on the 1st of January 2022, taking it from the value 1 year earlier, and coming up with the unrealized gain. However, that kind of is, when I say kind of, it is indirectly in the calculation, but because that's what the value's gone up. So in the Netherlands, what you'd say, what the Dutch taxman would say, is that unrealized gain is the increase in assets. So your assets are worth 100k here in euros. Once again, you're deemed or you're presumed. We assume that the rate of return is 5%, and therefore.
Just one question. I see some question in the chat.
Oh.
What do you mean by rate of return?
It's basically a return on investment, as in an assumed return of an investment. So
in that case is 100% rate of return, right? Because you bought for 50.
So even though the rate of return on investment, is essentially you've doubled it, 100%. That's why I said earlier, the rate of return doesn't correspond in reality to what it is. I think the thinking is that imagine if your assets were worth 100k 1 year, and it's got exactly the same value. You still have to pay some kind of tax on that. So you have like an effective or presumed rate of return, and the value would be essentially whatever your assets are worth times 5%, which is 5,000. But that's not the tax that you pay. That's just the amount that you pay tax on. So you take that. So the bill isn't as high as that. It's more like you take the tax rate and you multiply it by that. So it comes out to be a lot lower. So it's almost like 1% effectively, instead of a 20%, 5% times 20%. So
let me see if I understood correctly. So if there's an increase in value, that increase in value is what they tax me on. If there's no tax in that, if there's no increase in value, the same value, they would input a rate of return of 5% and tax on that amount regardless of, so like every year I would be able to, So every year would have to pay taxes in the Netherlands. Is that correct?
Yeah, yeah. As long as you had as long as you have assets of value, then you would pay this tax. Yes.
Okay, I see.
I think the approach is usually you take your assets and you take off your liabilities. So, for example, if you had a house that with a mortgage of, say, I don't know, 200,000 euros, and you had 100,000 euros to pay off, then your net assets would be 100,000, and that would be the amount on which you'd pay tax after applying the rate of return and after applying the rate of tax. Then you'd pay that back to the tax man. So it's a unfamiliar approach to people who haven't seen the unrealized gain, and a lot of people wouldn't have done. But it's similar thing to what you might see in some countries in terms of like a wealth tax, and there are advantages and disadvantages to it. I remember speaking to one client who was going from the other way around. He was a tax resident in Netherlands and is coming back to the UK, and they were so confused. They'd been in the Netherlands so long that they were so they didn't mind what the actual tax bill was at the end, but they just thought, oh, it's just so easy in the Netherlands sometimes, because I just take what the value is at that date and I just follow, or my accountant follows a particular formula. It's relatively easy to, I'd say it's simple enough to understand, so that whereas back in the UK, you've got to go through every single transaction in your history, and you know that can take up a lot of time, especially over a year. People, even just 3 trades a day, or more likely some have gone even it's more like hundreds in a month as well. So you can really find out. I'm also realizing that slightly conscious of time, so let's go straight into so even though you haven't sold any crypto assets, you still pay tax. I think that's the main theme that we've got out of this. Unrealized gain, you pay tax if you haven't, even if you haven't sold it. Realized gain is when you dispose of it, sell it, exchange it, give it away, which are the main triggers. So thank you so much for the opportunity.